Hello and happy Easter. I just wanted to do a very quick update because we have some more definition on technical levels. What's important to notice here is that the model score keeps on getting more negative even with bounces in risk. Okay, this is not good. As you can see from this line, this green line, we keep on getting worse and worse scores throughout the week, even as SPY bounced. This is not good, and it basically tells you that we will continue to have episodes of liquidation. The liquidation can actually be seen in DXY. It just cannot rally at all. I did think that we would trade in this range, and in this range we have traded, but all we have managed to do is allow for these Bollinger Bands to open up and open up the downside. Now, what is interesting is that if you go back to 2017, when Trump 1 came into being, you got very much the same kind of move, and that move initially exhausted somewhere in this area, the 93 to 95 area. I think that it's highly likely that we revisit it. And what does that really mean for the components, i.e. Euro USD? I think that that means, if you have a look back at 2017, it means somewhere around this 116 to 119, just short of 120 area. We are well above the 112 area and we can't go back within it. So I think that over the course of the next several days and weeks, we are likely to go into that area. What is also interesting is to match this against something which very few people ever look at, which is the Euro index, which is just the Euro as opposed to the DXY index. And what we can see is that when it starts breaking above 112, which we have, it tends to go to 119. So whichever way you skin this cat, it's basically telling you that you have another 5-6% to go on whether you look at it in DXY terms or in Euro terms. And you can see how important that level is. It goes all the way back to 2010 and all the bounces from there. I think it's almost a given that we go up towards that level over the course of the next, 4 to 6 weeks. It's the natural level and it matches the DXY. The other thing that I found interesting is to look at Euro CHF. We are breaking down on Euro CHF, and we all know the Swiss is a sort of like risk-off currency. What is the signal there? What is the level? It's this lowest close at 92.20. This to me just looks like a bear flag that's going to break down, and at some stage the Euro CHF goes down, and that means that USD CHF leads. Have a look at USD CHF. These are the lowest levels since basically back in 2011 when the big Euro CHF event happened. This 78.45 is the lowest monthly close. We closed the month there, then of course we had a huge liquidation and then bounced straight up. To me, it's very unlikely that at any stage we go above 84, but that really is the level that I think it tests. It tests all the way down to 78, and that's at least another 3%, and if not, it goes down to the liquidation lows, which are around 71. So whichever way you skin this cat, it's basically saying that the dollar is going to depreciate further, somewhere around the 4, 5, 6%, which is not a small move, and it just tells you that this liquidation and repatriation is not over as yet. We have another 4, 5% minimum, so do not be fooled into covering your short DXY positions or long Euro USD. You're actually looking for levels to increase your position, whether you do it via options or via outrights, but you're looking to put that risk on as opposed to reduce it. In risk, here we have ITOT over government. And as you can see in the liquidation, we got very, very close to this very important break level. I think that we are likely to slowly revisit it. I don't think it breaks. I don't think it breaks for a long time. But I think it will be revisited at some stage. And that's why I say that the liquidation, repatriation, whatever you like to call it, is not over. I think that we are likely to revisit these levels and bounce off them. In no way do I think that equities break down and go to hell. I think they will be bought, and there are some very good buying levels, but I think it needs to be retested, this level. It just needs to do something like this and test it a few times, and then it can bounce. But for the time being, I just remain negative on risk overall. Here we have the ARPA ETF, which is basically equities, bonds, and gold. And last week it was levitated by the bonds and the gold. But as you can see, we are at resistance levels. It's not going to go very far to the upside, and even if it does, it's coming back. It's going to retest this 1780 level, 1790, whatever it is. I have no doubt that it's going to at least test 1835 again. Now, it seems to be going sideways as opposed to straight down, and that is another thing which tells me that even if it goes and tests these levels, it's a bounce. It's going to be a bounce from there. So you really want to have bids in here, which means that if we revisit the lows in equities, they are buys. This is TIP over TLT. This just shows you that from 2020, when the inflationary period started, it's been much better, of course, to be in TIPS as opposed to nominal bonds. And we are now back to 2010. This really doesn't make, it makes a lot of sense, but what it's saying is that prefer the TIP, because we are breaking out of something like a 15-year nominal is better than TIP. Okay, might go sideways, but it's telling you all you need to know. Inflation is not going to be tamed just now. It just shows you that you have to be in TIP and not in nominals, and when that is the situation, the yield curve cannot do anything but steepen. And here you have 230s. Now, did it do anything last week? No, not really. But what I'm trying to show you is that the path of least resistance continues to be down. I have no doubt that over the course of next few weeks, we trade around this 140 level, which is such an important level. And I think from there it bounces like crazy. How does that affect equities? Well, it just depends what is moving. But to me, it tells me that it's going to be the short end that moves rather than the long end, or a bit of both. But if we're going to get another 40 basis points of steepening between the 2s and the 30s, that is very, very significant. It can come from a combination of the 30s doing nothing and the 2s going down another 40 basis points, which basically tells you that the data rolls over and the market starts anticipating very fast cuts from the Fed. One thing that I'm absolutely convinced of is that when the data has rolled over and the Fed knows this, they are going to be behind the curve. No way do they cut by 25s. They cut by 50 plus. So that is what is likely to happen, and that ties in with the DXY going another 4-5%. To me, all you can do is look for levels to put on steepeners, look for levels to buy tips as opposed to buying nominals, and remain short of the US dollar or look for levels to put that position on. I want to show you why this 52-54 level is so important, whatever it is. On the monthlies, it's extremely important. We spent 3 months trading here before we broke above it, and then we never looked back. So this level is extremely, extremely important. And here, and I will enlarge it, you saw last week how we just couldn't close a single 195-minute bar below it. And that is the real support. To me, if we start closing below 52.57 in SPY, we are going down and retesting these levels down here. And I can also show you that on the clean chart. This is that level, 52.54. We spent ages trying to break it, right? Ages. And it's very significant swing support. You can see these days here that it topped up there, then it broke, then it found support and never closed below it. A close below it, to me, signals the start of another move down, and I would expect that move to peter out around the 50.48 area, if not the 49.56. Again, I am not looking for a collapse in equities. I'm looking for them to remain weak on a spread to other assets. And finally, something that I mentioned on the feed, but I want you to have another look at it so you understand what I'm talking about. Now, the VIX spent all week last week going down from the previous close, which was 37-ish, all the way down to 30 and below where it closed. In the meantime, did equities rally? No, they went down 1% on the week. So you have the situation in which volatility is going down, but so are equity prices, not a lot, but down. What I think this means is that the panic phase of hedge everything, get rid of everything, stop yourself out is over, and now we are in a more reasoned phase of spreads adjusting and so on. This still means that if we can't start going below the 22 to 20 area, which I don't think we can, we will fill this gap, and it's going to happen with lower prices, which to me says, yes, equities are going to go down, but the moves are not going to be anywhere near as panicky as they were in this period. We might go and retest the low, but we're not going to break the low, or we get very close to the low and then we bounce like crazy. I think the likelihood, the highest likelihood, the biggest risk reward is going to be wait for equities, remain short of equities until they try to retest the previous lows. And I'll show you that chart again. These levels here to me are favored around the 50.48. That kind of level makes sense to look for another bounce. But in the meantime, I think we do trade again in this area between 50.48 and 49.56. You can't be more precise than that, but I think that that causes our part to fall down to levels which are buys, are bounce buys, and the same thing here in SPY. It might easily go back all the way up to 5400 from these levels. So that is what you're looking for. You're looking for weakness and then a bounce. And finally, a look at the move index, which people don't look at enough. It's telling me that it's coming down, but that it's also turning. And I think that if we see these kind of levels next week around the 103 to 105 area, we really have to start buying longer term straddles. Something big is going to happen in the bonds and volatility is going to go up into the 150s again. That is what the market is indicating here, and it's indicating that there's very little chance that we start breaking down below the 100 level and stay there. So I think that longer term straddles are going to be very much indicated for what we're looking at. And it tells me, how can I put it? It tells me that when the moves in the bonds start taking place, they're going to be very big. And that tells me that something is brewing, that you're going to have those 5-6% moves in the dollar, and you're also going to get 30-40 basis points moves in the bonds without any problems whatsoever. So it's the last sort of tie-in to what I've been telling you, that there will be some very big moves coming up. Okay, have a wonderful Easter, and I'll tweet you on Monday.